I am obviously Aaron Connor from Puro Connor and Strauss. As you can see, we're joined by Dave Wojcicki, my partner Lou Puro, remotely, and also Michael Bates and John Brazonis from TRUSTCO. So welcome, thanks for being here. Thank you to our sponsor, as I said, it's TRUSTCO Bank, your hometown bank. Michael Bates and John Brazonis will be talking a little bit about their trust services, their estate services. So we have that upcoming, and you can look forward to that. Our agenda today is to go through some trust planning basics, trust funding and related tax issues, revocable trusts, irrevocable trusts, lifetime administration. So what that means is what happens with your trust as you're alive and what you're doing, moving stuff in and out or getting income out, that kind of thing. Tax reporting, accounting during your lifetime, which Dave will take the lead on, and then trust administration at death, paying bills, distributions to your ultimate beneficiaries, and tax and accounting issues that we face there. First up, we have a brief poll. What interests you about trust administration? We have several choices. I have a trust and I want to learn more. I'm thinking of creating a trust. My parents may benefit from a trust. I'm a professional whose business involves trust planning. We also have a second question. If you have a trust, what's your role? Are you a grantor, the person who established the trust, the trustee, the fiduciary for the person who established the trust, or a beneficiary? Or you're not sure, that's okay. It's just let us know that as well. And we'll give you a minute to do this. All right, so looks like we've got some answers. And so what interests you? A lot of you have a trust and you want to learn more. My parents may benefit from having a trust. That's a small answer, small portion of you. We have some professionals on. A lot of you are a grantor and a trustee. Some of you are a beneficiary, and some of you are not sure. But hopefully by the end of the program, you will be. So we can move on from here. There are several types of trusts. In our practice, we deal with all of these. Living versus testamentary. And all testamentary means is a trust created under a will for someone. There are revocable trusts, trusts that you can revoke or take away at any point during your lifetime. Irrevocable, which seems to indicate there may be an issue with whether you can revoke it or not, but we draft them very carefully here and allow you to retain the ability to revoke that. Life insurance trusts, which aren't quite as hot as they were at one time, but that may change. Retirement plan trusts, these are trusts that we've seen a growing use for because a lot more of our clients have large retirement accounts and they don't want to leave that all to a beneficiary outright, or they want to make sure that there's a stretch, or retirement plans are good for special needs planning as well. We do straight special needs trusts. We also have dynasty trusts, and those really are trusts that go on for a period of time over many generations. It may sound like that is not something for your average person, but I think as we've seen in our practice, Lou, that a lot of people can benefit from a dynasty trust, even if they're not the Rockefellers.
It's different scales of dynasty trust. You hear that, and a lot of people think of the old show Dynasty and Crystal Carrington, and it isn't necessarily about that. What it's about is keeping the wealth that you've accumulated, whether it's your primary residence, whether you have bank accounts, whether the beneficiaries are getting IRAs, but keeping them intact for your children, for your grandchildren, perhaps your great-grandchildren. And we're able to create trusts downstream that wrap that wealth up allow control, allow flexibility, allow people to manage and access the money and the assets, but protect it from creditors, protect it from divorcing spouses, from bankruptcies. So a lot of clients, me included, want to protect our children, give them as much advantage as we can, but protect what we've given them. And these types of trusts go on in multiple generations. And that's what we're referring to in that dynasty trust.
Great, thank you. We also do asset protection trusts. These are sometimes done as part of high-end planning, or if you're in a employment like a surgeon or a doctor and you want to make sure that certain assets aren't available if something goes wrong. And a beneficiary controlled trust is a trust where you leave money to your beneficiary. They are the trustee, but it is also protected from creditors, just like a dynasty trust. So those are some of the many, many types of trusts. What is a trust in particular? A trust is a legal contract that creates relationships. Grantor, that's the person who establishes the trust, hands over assets to a trustee to manage for other people or themselves. So in some of these relationships, the grantor, the trustee, and the beneficiary are all the same person. I know that's counterintuitive, but that's certainly true in a revocable trust. Ultimately, obviously, the beneficiaries will be other people for what's left in the trust. But in that case, usually in the beginning, the person is wearing all three hats. Trust provides for lifetime management of assets, meaning how they're invested, protection of homes, all of those things. And we'll go through some of the differences, but in a revocable trust, a lifetime management is just like you were doing previously. In an irrevocable trust, there may be some nuances to that. One of the big things that our clients are really interested in is avoiding probate and assuring privacy. A trust gives you both of those things, and we'll go through what the probate process looks like and why you would want to avoid that. Can be used, obviously, to protect assets. Here we're talking really about irrevocable trusts. Reduction of taxes, again, is something that may be coming back into play as we see that the estate tax is likely to come down from its very high level right now. So that may impact more people. We may be doing more trusts for that purpose. We'll have to wait and see. Trustee is responsible for managing trust assets and administering the trust. They are a fiduciary. I think one of the most common questions I get from clients is, what is a fiduciary? Well, specifically, a fiduciary is someone who has to act in the best interest of another person, that person being the principal, in this case, the grantor. So the trustee can't just take the trust assets and do whatever they want if they're not theirs. They have to act in the best interest of someone else, and that's what we call a fiduciary duty. So trust funding, one of the big topics. On the day your documents are drafted and reviewed, a document execution takes place. This is generally done at our office. Can be done remotely, at least for the time being. During the pandemic, we've been doing some video document executions. At this point, so I think it's just a brief second to back up. At this point, we've created a set of drafts. We've sent them to the client for a review. We've had a meeting to go over the drafts, make changes, and then they've been finalized. That does not mean that sometimes the client comes in the morning of the document execution and makes some changes, and we do those on the fly. That happens as well. But at some point, we've finalized the documents, and you're going to take a look at our post-document execution checklist, or your planning documents, excuse me, which is form number 1 in your packet. And it goes through a lot of what you're going to get, what copies you're going to have, what you're going to get an original of, and who you may want the other copies to be sent to. Specifically, if you're appointing someone power of attorney, generally speaking, it's a good idea for them to have a copy of the document. If you're appointing someone the trustee, we want to make sure that they have a copy of the document so they know what their responsibilities are. We also have a trust funding kit, which is also in your materials. We have a trust funding letter, which is a very detailed letter about how assets can go into a trust. We'll talk about what does and what doesn't go in, but it instructs you how to open a bank account, how to transfer stock accounts, how to maybe designate beneficiaries on an IRA, or how to retitle life insurance. Generally speaking, we take care of transferring real property into the trust because that requires a deed. If you have corporate interest, it may just be an assignment. It just really kind of depends on what the nature of the corporate interest is, but the trust funding letter goes through all of those things. We also provide with an attorney certified copy of, or I'm sorry, certification of trust, which is a 2-page document that basically sets out everything that a financial institution would need to know about the trust, whether it's tax reported under an EIN number, which we would do if it's an irrevocable trust, or if it's a tax reported under a social security number in the case of a revocable trust, who the trustees are and what their acting powers are. Most times that is satisfactory to do what you need to do with setting up an account. We also provide at that time a fully certified copy of the trust, which means an attorney has said, this is a real copy of the trust. I know that sounds a little strange, but it is important to have that. Occasionally, assessors or financial institutions will not fund until they see a full copy of the trust, and it's important to have that. And we also include a trust funding worksheet, which is, I would say, one of Lou's favorite documents, certainly. And
they're all my favorites, Aaron. I love them all equally. I don't want to discriminate.
But the trust funding worksheet goes through what the assets are, whether they're going to be retitled, who's responsible for retitling them or changing the beneficiary, and whether we have proof here in the office, whether it's been retitled. And why do we need proof? Well, if it's been retitled, well, we're not going to put it on the Schedule A, which is where all the assets of a trust are listed until we know that it's been retitled. And we want to make sure that you fund your trust, because we've seen a number of people not fund their trust and not get the full value of the trust. And it's really, if you're going to go do a trust, you want to make sure that you funded it correctly. And I think Lou would agree that the trust funding is a critical, important part of this process.
Yeah, we wouldn't have created all these stinking forms if it wasn't. So, when you do a trust, when you create a trust, it's a document that standing by itself is okay, but it needs another document than your will to pour assets into it. The trust funding process is the secret sauce, if you will. It's what a lot of people ignore, a lot of attorneys ignore, but what we're doing, and we're going to talk about probate later on in the program, but what we're doing is fast forwarding, and we're doing all the work that usually takes a year or two through the probate process, and we're doing it now. You're transferring deeds to property, you're transferring assets, you're retitling bank accounts so that your trust and your trustee, and we're going to talk about who that is in just a moment, when your trust and trustee own those assets, if you become incapacitated and later upon your death, those assets are already secured inside the trust, and the trustee then just follows your guidance, the provisions that you put in the trust, the terms that you want for your beneficiaries. All of those assets funnel directly and literally instantaneously into those other vehicles without the necessity of going through the court process. So we talk about some interesting assets, Aaron, like cars and trailers and motorcycles and boats. But to do this perfectly, all of those things should be in the trust. Cars in New York, you can do one vehicle. Typically, DMV under $25,000 will transfer one car without having to go through probate. But to be safe, retitling everything in the name of your trust is absolutely critical. So much so that we have all these forms, but more, we actually have a trust funding coordinator, a dedicated staff person who works with our clients, Shannon McNeil, who is great at making sure that you do your homework and get all the accounts and all the assets into the name of the trust.
Absolutely. Agree, obviously, 100% with all of that. We're going to talk about some tricky assets and some assets that sometimes get missed. But right now we have a poll. The question is, the most common reason a trust fails was it improperly drafted? The trustee steals the money. Assets were not properly transferred into the trust. Tax returns were filed improperly. So I think this may be a leading question, but if you're going to go ahead and vote now, that would be great.
I think our audience is listening.
All right, we have a very good and wise audience today. The number one reason is absolutely that assets were not properly transferred into the trust. Could a trust fail because it was improperly drafted? Yes, we don't see a lot of that. We certainly have seen a few trusts where the trustee is run off with the money, so appointing the proper person is a big part of it. And I would defer, obviously, to Dave about the last issue. But
yeah, just one point here, Aaron. Proper execution of the trust is also very important. When you come into our office, you sign it, we notarize it, it's done on the spot. We make sure the trustees sign it. In New York State, a notary signature and a notary is what is necessary with something called a jurat, the clause that precedes the notary signing. If you're in Florida or you're thinking of moving to Florida, Florida has different rules. So these are state-specific rules. And in Florida, you have to have 2 witnesses and a notary. So it's even more than a will. In New York State, it's simpler than a will. In Florida, it's more intense than a will. So we do Florida work. We're Florida licensed. So if you're contemplating Florida or you live in Florida, those are things that you need to look at to make sure. And we've seen some documents come through that were not done quite right. They were done individually, you know, LegalZoom or Susie Ormond or somebody bought a trust and it just wasn't signed properly. Make sure that you have it executed in accordance with state law.
Very important and critical, because if the trust is not valid, you're not going to get what you thought you bargained for. So we're going to talk a little more specifically about the trust funding process. It's a little different. We're going to divide the world here into revocable trusts and irrevocable trusts. In a revocable trust, essentially all of your assets are going to go in there. All right, we're doing a revocable trust to avoid probate, to set up probably further trusts. There's no reason not to put your assets in there, all bank accounts. And it will go over the one exception for the revocable trust after. Irrevocable trust depends on where you're at in life. If we're doing this proactively and, you know, Medicaid is in the more distant future, as you know, you think anyway, obviously none of us know, we might start by putting your house in and then putting our life insurance that you're not planning on cashing in. But over time, as you get older, we may put more and more money in. Obviously, it's beneficial to put the money in or the assets in sooner rather than later, because none of us know when our 5-year clock is going to be up. But usually I see younger people, and younger people in my world is in their 60s, start
Thank you.
Kind of slowly putting assets in. So that's something to think about and something we discuss at length with our clients. Certainly, if you own property in 2 states, we want that in the trust, and because we don't want to end up probating in 2 places. Annuities sometimes are tricky in irrevocable trusts. Some financial houses take the position that the transfer is a taxable event. We've always taken the position that it's not, but that does become tricky.
There's actually a private letter ruling that came down within the last month where the IRS agrees with us and says that a transfer of an annuity into a trust, even an irrevocable trust, even a non-grantor trust, all things we'll talk about later in the program, does not trigger the taxation on the annuity. So annuities, these are deferred annuities. You put a lump sum of money in, it grows with income tax consequences on the growth portion, ordinary income. If you transfer it to a trust, it doesn't trigger that income. So you can have it go into the trust and continue to accumulate tax deferred. Ultimately, somebody's going to pay tax on that, but that's just the way annuities work.
Correct. And for both of these trusts, we are not going to put your tax deferred retirement account into the trust. All right. We may make the beneficiary or the secondary beneficiary that trust, depending on the planning situation, but we're never going to transfer those to the trust because it would trip the taxation on the entire amount on that transfer. It's important to know with both trusts, you keep your star exemption as long as there's an irrevocable trust anyway. We keep the life estate language, which allows that to be kept. And you also get your $250,000 per person capital gains exemption on sale, which is also very important.
Aaron, it might be a good time to talk about the trust meter. You know, where do you fall on that meter? Where does the dial land for your personal estate plan? The age of the client, your age, makes a difference. Mm-hmm. And we see more younger people gravitating towards revocable trusts unless they have significant net worth. because you can maintain control, be your own trustee, have full access to everything. It's more of a contingency plan, but it keeps you out of probate and it keeps your assets secure while you're alive should you become incapacitated. If you get to the point where you have a taxable situation, we're going to talk a little bit about the current estate tax proposals. Then we do trust for tax motivated purposes and we move assets out of your estate to get them so that they can grow tax free using your exemption against the gift and estate tax. We'll talk a little bit more about that again later. And then the most common reason that people use the irrevocable trust as we age, and I'm 62, if I didn't have some insurance to cover the cost of long-term care, then I would be seriously considering an irrevocable trust. But I have insurance and I have income that would cover that risk. If you don't, then you need to consider the irrevocable trust for Medicaid asset protection purposes. And that the revocable and the Medicaid asset protection trust are what most of our clients are contemplating, one or the other.
Absolutely. Very good points. So in the trust funding process, I think something that often gets lost is tangible personal property. And if you don't assign it, there's going to be a very strong argument that you might have to probate it. Now, if it's just typical things, you might be able to avoid it. But if you have anything of value, any kind of collection, or heirlooms that may be of dispute, you really need to make sure that, one, it's assigned to the trust that you've created, and two, perhaps even better, that you've done, which is Form 6, a personal property memo, which says what the item is and who it goes to. All right, some clients are hesitant to do this, but in my experience, it's much better if the grantor or the grantors decide where this personal property is going to go, because you can't divide personal property. The court can't divide personal property. All they can do is order it to be sold. So those disputes happen. And 9 times out of 10, if the person who owned the object first says who it's going to go to, it's going to be effective. The only reasons it wouldn't be would be undue influence or lack of capacity, which are difficult things to prove. So I would strongly suggest that to do the form.
A lot of people think this is never going to create an issue and I'll just let the kids divvy it up and let them decide. But Aaron, you do the estate litigation. There is no emotional attachment to a bank account,
right?
But there is an emotional attachment to a painting, to a collection, to personal memorabilia, to jewelry. And those emotions pour out when someone dies. And if you can be specific in this distribution memorandum that we work with you on, you can create a pathway that your executor, your trustee rather, can have clear authority and clear lines to distribute things. No arguments. It takes away a lot of angst from those families.
Absolutely. And you really can save people a lot, well, money, first of all, but second of all, a lot of mental anguish by doing this. And like I said, it's effective to do it with a trust, and it's going to save people a lot of time and effort. With real property, again, we handled the deed transfers to the trust. That's really the only way to transfer real property. Again, if you have shares or you have LLC interests, those need to be assigned to a trust as well. Sometimes you have to make sure that the LLC interests are in fact assignable to a trust, but most of the time they are. But that is an issue that also needs to be discussed. We have this, next up, we have treatment of retirement accounts. I think this is a good slide for Lou to talk about, and the Secure Act, how that's changed. Thanks.
Yeah, as you mentioned, Aaron, so many people today, their primary asset other than their home is their IRA, 401k, 403b. They're all treated from a tax perspective the same way. You put money in without ever paying tax on it. That money has accumulated tax deferred, but when you pull it out, that is 100% taxable. A little known law passed effective January 1 of 2020. This was during the Trump administration. The government was not happy that a lot of people were stretching these accounts using grandchildren's life expectancies and moving assets downstream so that the income tax burden never fell. They were expecting this tax revenue. When they passed the laws allowing retirement accounts, qualified deferral, they weren't expecting people to get good at it and to be able to stretch it for so long. So on January 1 of 2020, the Secure Act went into effect, putting in place something called the 10-year rule. What that means is when a beneficiary inherits an IRA or 401k, they have to take it out over 10 years which pushes the money out and puts it into a tax bracket that the child is in at the time. So they're going to get taxed on 100% of that money over a 10-year time period. So this now requires careful planning, lining it up with your trust planning. A lot of clients are looking at Roth conversions now because that's a powerful way to pay some tax up front and then allow the deferral, and then the child can allow that deferral for that 10-year period and pull it all out tax-free. So we work closely with your financial advisor. This is really a joint decision, how to name that beneficiary and how to make the best use of your qualified retirement funds. There are some exceptions to the rules. We have a full webinar on this on our website that we did last year when the law was passed, which covers all of the exceptions for disabled children, chronically ill individuals, spouses. So I would commend that to you. If you do have an IRA, 401k, it's a big piece of your estate. Watch that webinar and look at how you can strategize with your financial planner, your attorney, your accountant to make the best use of those taxable dollars.
All right, so now some talk about revocable trust funding. Okay, so just again, a note about how a revocable trust works. The grantor or grantors move assets into the revocable trust. Generally speaking, 9 times or 95 times out of 100, the grantor of the revocable trust is also the trustee. During their lifetime, they're the beneficiaries of this trust, meaning they use it as they see fit. And then the trust specifies how the assets are to be distributed on death, whether that's to their family, to charitable organizations, or other places. In an irrevocable trust, again, the grantor, the person establishing the trust, places assets in here. In our practice, we do not allow the grantor to be the trustee. So recently, we've seen more and more attacks, or we feel that more and more attacks are coming on Medicaid trusts. Certainly, if you're your own trustee, you don't have much separation. We are not comfortable that that provides the clients with the protection that they're looking for. So we have someone else be a trustee. Most often children, doesn't have to be, it could be a friend, brother, sister, neighbor, it doesn't really matter. It has to be someone obviously you trust and someone who will do the right thing. Here, the trustee manages the assets for the benefit of the grantor and then ultimately the beneficiary. The grantor of an irrevocable trust is entitled to income out of it, if they so choose. Principal has to be handled more carefully, no principal directly back to the grantor. And then at the end of the day, whatever's left goes on to the remainder people out according to the terms of the trust. Again, all outside of probate. What can you put in an irrevocable trust? Homes, bank accounts, stocks and bonds, annuities, as we talked about, life insurance, business interests, real estate. Again, income can be paid out, no principal directly to the grantor, although we do draft the trust with lifetime beneficiaries who can access principal and give it back to the grantor. It needs to be done carefully. We'd like clients to talk to us before they do that, but you do have the ability, even though it's an irrevocable trust, to get principal back to the grantor in that fashion.
And Aaron, our clients all express similar concerns. Oh, irrevocable, that's a scary term. I don't want anything that I can't change. I don't want anything that's irrevocable. I don't really want to give up control to a trustee, somebody other than myself, who I then have to rely on. And what if the beneficiaries have issues? What if they have problems, or they go off the reservation and they're not treating me properly? So in the design of the trust, and this has to be done very, very carefully. This is now like microsurgery because the government, the counties and the state are looking much more at the trusts and the design of the trusts and beginning to poke at them and try to attack them, saying that they give you too much control. Well, that's why we don't have you as the trustee. That takes one of their major arguments away. But what if your trustee isn't doing the right thing, Aaron? What do?
You remove them. They're fired.
That's right. And what if the beneficiaries go off the reservation and aren't doing the right things? That's an even bigger result for the beneficiary. They might not care that they're not doing the trusteeship. They're going to care if they're not the beneficiary. What do?
You remove them or you reduce their share. So I mean, to me, I always say that's the bigger stick that the client has. Sure, you can change your trustee at any time, but the one that keeps more people in line is knowing that they may lose out on any ultimate share that they may get. So,
and that becomes very critical in two situations, because Aaron mentioned that the back door to the trust is principal, the actual assets, the stocks, the money can be given out to other beneficiaries other than yourself. What do those beneficiaries then do with it? Whatever they want. But can they use it back for me? The answer is yes. So you want to make sure that you have the ability to put the right people in the trust as beneficiaries. And if they're not cooperating, you can remove them and replace them. So you always have that lever of control. And Aaron, this is the feature that a lot of people don't believe, but under New York law, irrevocable isn't irrevocable.
correct. As long as it's drafted correctly, when the right people consent, the trust can be revoked, even though it's, quote, irrevocable. We draft these very carefully, so the can be revoked very easily by the grantor. But if it's not drafted correctly, and this is one of the reasons you need to use somebody who knows what they're doing, this revocation power doesn't exist if there's a minor who's a beneficiary. So that becomes a big thing that needs to be paid attention to. So people are generally doing irrevocable trusts for Medicaid protection or Medicaid accessibility or eligibility. Home care rules were to change on Thursday, October 1st, 2020. They were certainly enacted in 2020, which brought in a look back period of 30 months, which had been zero. So these were big changes. Right now, the rules are still set that apply a transfer penalty on transfers made after October 1st, but we have no date at this point in time when that penalty period will be calculated. There's a number of other home care rules that were changed and that should be phased in 2021. One of the more critical ones is that your primary care physician will no longer have much of a role in this process.
Yeah. For anyone contemplating Medicaid application, the New York State Bar Association has an elder law section. We're very active members. I used to chair that section of the state bar, and they have continually pushed this off, but they sent out materials. There's an executive committee meeting coming up this week, and the materials indicate that the state intends to put the rules in effect in July. That's the latest guidance that they've gotten, which means if you want to make transfers and apply for Medicaid, you have to do the transfers in May and be ready to apply and have everything clear so that you can apply in June. And this runs on a month-to-month basis. So if you're in this situation or your loved one is in this situation and you're contemplating whether Medicaid home care is right, now is the time to get a thorough assessment to determine whether they're eligible and what they would be eligible for. And if you do want to apply, get the application filed in June, which means all your transfers have to be done in May.
Right. So if you, under that circumstance, if you waited till July or August, any transfer would be subject to a 30-month look back period, where if you'd done it just a month before, you would have no look back and a much cleaner picture and a much easier application process.
Yeah.
So it's critically important, like everything, timing in life is probably everything. So,
and there are a lot of myths out there about Medicaid. Many people think, oh, I can only get 4 hours a day or 8 hours a day. And the truth in New York, and again, state specific, but New York has probably the most generous Medicaid home care program in the country. And we routinely, not in every case, but routinely, if it's warranted, if the doctor backs us up that 24-hour care is needed, Medicaid will provide 24/7 care at home, which is, let's face it, where we all would love to be until the day we die. As my mom said, I'm only leaving this house feet first. So if you want to be at home, Medicaid home care is a way that you can do that, but it's getting much more difficult as of July 1.
Absolutely. So if that's something in the future, in the immediate future or near future for you, I'd encourage you to give us a call or contact us in the question box, and we'll make sure to get back to you. Now, I'm going to hand it over to Mr. Dave Wojcicki to talk about trust taxation.
Thanks, Aaron. Okay, now that you've got a separate legal entity, there are some responsibilities. Generally, the trustee has responsibilities from a tax perspective, and The IRS wants to make sure they have their hands out and make sure there's no money missing any place that they're not able to get any tax revenue from. So when you have a separate legal entity, a trust we talked about, there are separate trust tax returns that are required to be filed. When you form the trust, most trusts will require a separate tax ID number. It's not required if the grantor and the trustee are the same. As Lou mentioned before, they generally don't have the same trustee and the grantor. So we generally recommend that you get a tax ID whether it's required or not, just because it separates the filing and you're going to need one at some point anyway, and it just makes it a lot cleaner. So when you determine you've got a tax ID number, just like your social security number, it just happens to be the ID number of the trust to identify it for all your tax filing. Then you need to determine what state you need to file in, which is similar to a business or similar to as an individual. So these are for non-grantor trusts. For a grantor trust, as we get to what the rules are for that, they will file in the state of the grantor. Each state has its own rules as far as where the filing is. New York, it's where the individual at the individual is the time of the transfer is. For most people, probably on this seminar, it's going to be in New York, I'm guessing. If it happens to be in Florida, obviously Florida does not have a state tax. There's also different types of trusts. So once you form the trust, there's different provisions that'll dictate what type of trust it is. It's either going to be a grantor trust, a simple trust, or a complex trust. And each of those has different factors as to how to file and how the income is actually taxed. And you'll see that there's actually a Form 8 apparently in the packet that'll have some information for your tax preparer that will help, or perhaps the trustee if the trustee is going to file it for themselves. So we've got part of forming a trust is you may or may not have a completed gift depending on how the trust is formed. And as we'll see a little later relating to some of the changes that Biden is probably going to introduce or is looking to introduce, this is a fun area now, Lou, I would say. It's certainly going to get a little more interesting as far as how to plan for whether we want actually to be a completed gift into the trust at this point or not a completed gift. And it centers around a number of things, a step up in basis for income tax purposes, and also the estate tax and gift tax thresholds, which are quite high right now, as you can see on the slide. I would say most of these are probably not going to be completed gifts. So the Biden plan, as you can see, his obviously, I don't think there's any question that the estate tax is probably going to be reduced from its current level, which is 11 million. And if you're married and you have portability, it's essentially almost 23 million. It's 23 million. He will increase the estate tax rates, the gift tax rates, which top rate now is 40 on the Fed and 16 on the state. Looking to increase capital gains rates, and really one that's getting a lot of publicity is if he takes the capital gains rates and for those over $1 million moves them to ordinary, that's a big impact. It's from 20% to he wants to raise the individual rate back to where it was, which is 39.6%. And the two biggest things, the last two things are really the biggest headache that are going to be for people is repealing the step up in basis at death. And right now, if an asset is included in your estate, you had a house that you bought 50 years ago for 50,000 and it's worth 500,000, and you get the step up in basis at date of death, your beneficiaries could sell the house the next day if it was included in your estate for 500,000 and pay no income tax. And one of the proposals is to eliminate that step up, in which case if you sold that same house, you'd have a $450,000 gain. And that will cause not only a big tax, but really a nightmare in having your beneficiaries have to figure out what your basis was, which could come from 50 years ago and more. And the interesting part of the last thing that he's proposed is a deemed asset, sale of assets when they're gifted. So if you gift an asset, it would be deemed as if it was sold on that date, or at date of death, it would be deemed as sold, which is interesting because if it's deemed to be sold on date of death, you would receive a step up by virtue of the fact that you would have paid tax on it. So we don't know where these things are going, but Lou, I'm sure you'll chime in here because it's completely changing the way you're looking at these.
It's keeping us busy and keeping us on the edge of our seats, because the proposal for estate tax, right now, you have the $11.7 million federal exemption for both gift and estate. The Biden plan, the Sanders plan, the Democratic plan is to lower the estate tax exemption to 3.5. But a lot of people forget there's a corollary to that, which is lowering the gift tax exemption to $1 million, which really puts people in a box and prevents them from utilizing all of the wonderful tools we have available today to gift freely into trusts in very creative ways and utilize that $11.7 million exemption. We have a number of high net worth clients that we worked with in the fourth quarter. We're doing more now because people are seeing that this change is going to come. And it's important, Dave, to point out that the individual tax cuts that went into effect in 2017 are temporary. They're expiring anyway at the end of 2025. So this is an acceleration of the rollback to pre-Trump days, and it may be going further. The pendulum may swing further with these 3.5 million, 1 million gift tax exemption. So again, timing is everything. Getting this done before the law changes. We don't think they're going to do this on a retroactive basis, but if you don't get in before the law passes, they could do it as an immediately enacted and enforced provision. So if you do have estates over that 3.5 million, that's the number that we now have to look at and target to plan for. If you're a New York State resident, it's important to know that New York has a $5.9 million estate tax exemption, but New York has no gift tax. So you can gift as long as you survive 3 years, that gift escapes taxation entirely. So good time to look at all of these things. Historically, Biden, Sanders, they want to go back to 2009. Those were the rates in effect in 2009. 2010, if you remember, Dave, we had repeal.
Yep.
There was no estate tax. That was the end of the Bush tax provisions. It sunsetted in 2010. And they had a capital gains carryover. So there was no step up in basis. Well, lo and behold, within 6 months, they had to pass emergency provisions to reinstate the step up in basis because it hurts middle-class people.
Right.
It isn't targeted to the wealthy. It's targeted to anybody that tries to pass a home or a few stocks to a beneficiary. They then get hit with that capital gains tax, even though you're way under the estate tax threshold. So you need to pay attention now. This is volatile. It's going to be playing out in Washington with the bills and all of the rules that are going into play with the sequestration and all the different ways that they can get this passed. But we are going to get tax changes. We're trying to follow it and predict what's going to happen, but planning in advance now is absolutely essential.
Correct. Okay, so we've got the three types we talked about before: grantor trust, a simple trust, and a complex trust. And a grantor trust is it's really defined as when the grantor is retaining some type of control under the IRS rules that are going to require that the grantor pay the tax on it, regardless if they receive the income or not. There's still a separate tax filing, but the tax is actually paid by the grantor. So it's a relatively simple filing. Nothing will change from a income tax perspective. So if you happen to own some assets before we're paying tax on it, you transfer them into a trust that qualifies as a grantor trust. That income will end up back on the grantor's return, and your tax you paid before would not change. That'll be a good portion of the trust that are probably going to be designed for income tax reasons and also some estate and gift tax reasons that Lou and Aaron would be able to let you know when they set up the trust. Simple trust is just a trust. It does not qualify as a grantor trust. It's a trust where the beneficiary is required to receive all the income, generally at least on an annual basis. Often it's quarterly. There's no discretion. The trustee just does the accounting for the trust, determines what the income is, and it gets paid out by the beneficiary. There's an interesting rule for fiduciary accounting, and that is there's the concept of capital gains and principal and income. And in a simple trust, the capital gains get left behind. They do not get distributed out to the beneficiaries. So if I happen to create a simple trust and I said, hey, I want all the income to go to my child every year, regardless of what it is, and it happens to have a gain in some IBM stock inside the portfolio that I put inside the trust, the tax would actually be paid by the trust and it would not get pushed out to the beneficiary. When it's straight income, the income actually is paid by the beneficiary who actually receives the money, so that makes sense. And as we'll see later, that can cause some problems on the income tax side. And then finally, a complex trust. Complex trust is just something that doesn't qualify as a grantor trust or a simple trust. And it's no requirement. The trustee actually has discretion over what gets distributed out to the beneficiaries. This will push tax, can push tax out to the beneficiaries, or you can retain it in the trust itself, which has some advantages. This type of trust requires you really to know where you stand at year end, because the brackets between a trust and an individual are much different. And there may be reasons, even if you don't want to make distributions, there may be really good, compelling income tax reasons why you want to make distributions to trusts, just from a tax perspective. And we'll see a couple of quick examples of that just in the tax rate. So there is some planning opportunities with a complex trust. A brief poll. Okay, an individual taxpayer says the maximum rate of 37% once income is over $518,400. And a non-grantor trust, so a simple trust, a complex trust, that pays the maximum rate of 37% over income once income is over the following four amounts: 300,000, 162,700, 82,400, or 12,950. $12,950 was the majority of the people got it right. So obviously that's a very low income level to hit a top bracket, as opposed to if you compare it to the $518,000 for 37%, which goes back to the reason why you often want to push income out. So if I earned $13,000 in my individual name, I certainly wouldn't be paying at 37%, but a trust would. If you distribute it out, it gets pushed out, and the beneficiaries will actually end up paying the tax at their rate. So you can see the tax rates on the screen. Over $12,950, you're paying at a 37% tax bracket, which is a very high tax bracket. So planning needs to be paid attention to anytime you form a trust. If it's a grantor trust, again, the grantor pays the tax the same as it was before you made the trust, before you set up the trust and made the contribution of those assets. Simple trust will push out the income. It won't push out the capital gains unless you have a reason where you're pushing them out, a consistent reason. There is the ability to do that. And then finally, the complex trust, you can push them out by making that determination on an annual basis and what income you're pushing out. So income is the definition of income. If you think about principal being what you contribute to the trust as you begin. So for example, if you contribute $100 and then use that $100 to buy a $100 share of Apple, you would own the principal. That trust would be the Apple stock. When Apple produces dividends, the income that's produced, or the dividends that are produced, would be considered income from a trust perspective, and that is what would be distributed out in a simple trust. Those would be the income that's produced. So you need to keep track of both principal and income on an annual basis, because again, the income can be required to be distributed, or the income can be on a complex trust, the determination of whether to distribute income or not. But you need to separate the two types of income items, income and principal. So again, we talked about principal. Anything that you receive that you're going to produce a return on is considered principal. So any contribution of property would be considered principal. A contribution of stock would be the principal. A contribution of cash to the trust would be considered principal. And then what you convert that into is either going to produce more principal to replace the principal that you had, or it's going to produce income off the principal itself. Talked a couple of minutes ago about tax brackets, and having to look at some planning. There's also the net investment income tax that was passed a few years ago, and that is if you're in the top bracket, you pay an additional 3.8% above and beyond the 37%. So it's not just the 37.8%, 37% we talked about at the highest bracket. There's an additional 3.8%, and then of course you got the state rule. Now, the interesting rule in trust, it's a little different than an individual. As an individual, you're a cash basis taxpayer, which means, hey, if I receive money before December 31st, it's taxable. If I pay an expense before December 31st, I get a deduction for it. On the trust realm, because you as the trustee, remember, if it's a simple trust, you have to pay out all the income. Well, you don't know what the income is on December 31st until the end of the day, in theory. So the rules allow you a 65-day grace period to compute what the income was for that trust in the prior year, And if you make a distribution in the first 65 days of the following year, you can make an election to push that distribution back as if it was made in the prior year. And the reason that's important is because it gives you 65 days to plan and decide, hey, if I make a distribution, do I want to push it back to the prior year and consider that to be income to the beneficiaries who are in a lower bracket, or do I want it to remain in the current year of the distribution? It's the only way you really, rarely in tax realm, do you get any hindsight to be able to make a decision after the fact. And this is one of the areas you can. And that comes into play with both distributing income and capital gains.
Dave, this all sounds really complicated, and it is. But for virtually every client that we create a trust for during that client's lifetime, it is a grantor trust.
Correct.
Where you get into these distribution rules, we talk about trusts for beneficiaries, special needs trust, beneficiary control trust. Typically, upon the death of the grantor, the trust converts from a grantor trust into a complex trust, and you can then accumulate or distribute income. The 65-day rule then comes directly into play, and you need to manage, but it's not that hard because you get your 1099s, you sit down, you look at what the income of the trust is, you look at what the trust tax bracket is, what your tax bracket is, and you distribute enough money to move it into the lower tax bracket. So it's a routine that once you get used to it, you do it once, it's pretty easy to manage that. But a lot of our clients and their accountants don't know how to file a grantor trust return. And that is really easy. Can you just walk through that one more time, Dave?
Yeah, the grantor trust?
Yes.
Yeah.
Just the grantor trust letter.
Yeah, so on the, for a grantor trust, there's the face of the 1041s, I think we'll get to in a couple of minutes. I don't know if it's in this section.
Yeah, I'm just kind of highlight now that this, for most people, this isn't this complicated.
No, it's really not. And even with the complex trust, which it usually comes into play after something happens in the first trust, in the trust that you form. And we usually know what you're probably going to do in December. We generally have an idea of what's going to happen with the complex trust. The grantor trust, it's basically the grantor, when you form these trusts, you're going to take the same information you took previously and put it on your 1040. You're just going to put it on the 1041, which is the fiduciary form. It's just a separate ID number, a separate face to the form, but the actual 1099s are the same. They just happen to be in a different ID number now. You'll produce a statement, and that statement lines out a summary of all IBM dividends, Apple dividends, interest income. It's one piece of paper that goes to the grantor, and the grantor takes the information off of that grantor letter, which we'll see an example of, and puts it on their 1040. So it's really almost like reproducing your 1040 in a summary form, and then putting the information back on the 1041. And the reason that's done is because the IRS needs to cross-match your income. You're going to get a 1099 with the trust ID. The IRS wants to be able to see that, hey, this ID reported this income amount, and then that income amount gets cross-referenced back to your individual return. But from a tax preparation standpoint, it's pretty easy.
Thanks, Dave.
Great, thank you, Dave. So now we're on to lifetime administration. And what does that mean? Well, it depends on what type of trust you have. So again, we're talking about a revocable trust. You're the grantor, you're the trustee, you're the beneficiary. It's just you being you until the moment you can't be. Well, when could that be? That could be incapacity. All right. So one of the big positives, really aren't any negatives, but one of the big assets of a revocable trust is planning for incapacity. So at some point, you have dementia or you are in a coma just from some health event, the successor trustee takes over the administration of your trust, whomever you've chosen to do that. Maybe a spouse, maybe a child, maybe a professional, could be any of those people. How do we determine incapacity? Well, it depends on the client in some cases, but generally speaking, we use a physician's affidavit to determine incapacity. If there's been a removal of a trustee because they're claimed incapacity, they can then begin a process to kind of prove that they're capacitated or prove that they recapacitated. We can make it a court determination, but generally speaking, we're trying to stay out of court in a revocable trust, but it is an option. And if you disappear for a certain period of time, you'll be deemed incapacitated. That period is also fungible. Generally, we have it at 60 days, but in some cases, we made it significantly longer for management of your assets during your lifetime in a revocable trust. You are the person doing that. You're managing the investment of them, how they're invested. You are managing how they're doled out to you or whether to other people. And also you may have a child with special needs or a child that needs to be spendthrifted, meaning that they have, let's say, problems with money, and you can manage all of that through the revocable trust. In an irrevocable trust, we have a somewhat different situation. Again, as we've discussed, the grantor is not the trustee. Income out of the Medicaid Asset Protection Trust or irrevocable trust can come out to the grantor. So sometimes we are looking at whether this is a good thing or not, whether the grantor needs the income, or as Lou likes to do, sprinkle it out to some beneficiaries, right, Lou?
Yes. The other thing to keep in mind, this is one type of trust. If you're doing the tax version, when you want to move assets outside your estate, then the income is going to get sprinkled to other beneficiaries, not back to you, because you can't retain that lifetime interest in a trust that you're doing for tax motivated purposes. We very often put life insurance policies in trust to keep them out of an estate. But if you're doing a gifting trust for estate gift tax purposes, you would not be retaining these interests. In a Medicaid trust, different purpose, asset protection, you can keep the income.
Good point. Again, with the real property, there's no capital gains tax due on a Medicaid asset protection trust that we've drafted, because we've drafted it as a grantor trust, and we've retained the powers that you need to retain to make sure that that exemption is there. It's $250 per person. So if your property has increased in value more than $500,000 and you're a married couple, you still may have to pay capital gains tax. But predominantly, we see that that covers most of the gain for people that we are dealing with. Again, no principal directly to the grantor in a Medicaid Asset Protection Trust. The trustee can dole it out to the lifetime beneficiaries, and then they can get it back to the grantor. That brings us to our sponsor, TRUSTCO Bank and Investment Services. And I believe we have Michael Bates and John Rosanis with us. Good afternoon, gentlemen.
Good afternoon, Aaron. Can you see us okay?
I can see you.
No, that's good. We can see just you, and there we are. Okay. Thank you. I have to learn how to work this system. Thank you, Lou. Thank you, Aaron. Thank you, David, for having us over. My name is Michael Bates. I am a business development officer with TRUSTCO Bank and its Financial Services Department. In a moment, I'm going to introduce you to John Bristonis. But I just give you a little background on what my job is as I speak to you, is just to let you know that I pretty much work with the clients of the bank, and in a financial planning capacity. I work with clients from the branches from here right down to Westchester and back. Also work with attorneys and CPAs. We get referrals from those, and of course, existing clients give us referrals. That is what I do. I'm going to turn it over to John just to have him introduce himself and to tell you a little bit about what we're going to present today.
Sure. Thanks, Michael. And again, my name is John Bristonis, senior officer here in our trust department. And I just kind of wanted to touch today on a couple of benefits of using a corporate trustee when you're involved in trust planning. So often, a family member or an individual will be able to step into the role as trustee. There's some circumstances where that is not the case, and there's a benefit to using a corporate trustee. Trust administration, it can be a long and complicated process. Depending on the age of the beneficiary and the terms of the trust, trust can go for a number of years, even over the course of somebody's lifetime. So it might make sense to have a bank step in where a family member wouldn't exactly fit the role.
Excuse me, John, if I may, can you help us get on to the next slides? There we go. Okay. So, in terms of, a trustee has the opportunity to have the resources and expertise that maybe a family member would not. In this capacity, we can not only help with the administration of the trust, but we could also, help where
we can step in as the investment manager as well. So we can help with the administration, help with the investments, and help with the filing of the annual tax returns for a trust. You know, as a corporate trustee, we can act in an unbiased manner, and we can make difficult decisions where a family member might be more, have a more of a difficult time making those decisions, specifically with distributing principal under the terms of a trust. Long and short, you know, it's easier for a bank or a trust department to say no. It can be very difficult for a family member and cause stress within the family dynamic. And corporate trustees as a whole, we're bonded and insured. We're highly regulated, not only internally, but also by state and federal examiners. So there's a lot of oversight over what we do. And, you know, we act as a fiduciary, so we have that oversight to make sure that we're acting in the best interest of both the beneficiaries of the trust and the remainder beneficiaries. So in terms of estates, we also serve as a corporate executor, co-executor, or successor for an individual executor. When doing this, you know, we offer the same level of expertise and professionalism as we would do when working in terms of trust administration. We like to work with, you know, the attorneys, accountants for our clients. You know, we consider ourselves kind of a piece of the pie. The attorneys do a lot of draft, you know, all the legal documents. The accountants work with their financials and preparing their tax returns, and we like to step in the financial planning role. When acting as the executor of an estate, we not only do the estate administration, gathering the assets and making distributions, but we also work with attorneys, accountants to prepare the estate tax returns, the fiduciary income tax returns for the estate, and the decedent final return for the individual in the last year of their life.
Thank you, John. I appreciate that. What I neglected to mention up front, there are some handouts that you have. There is a menu of our service, which John has just gone over two of those, which is the trust administration and the estate administration aspect. I'm going to go over the investment aspect of our services. But you also will find the investment performance that we've had. That's current up until the end of March. You'll also see our fee schedules, the trust administration fee schedule and the estate administration fee schedule. So I just wanted to bring your attention to that. And talking to you a little bit about investment management, you know, in general, most corporate trustees will have a professional management or advisory service for you. And they will incorporate building an allocation of fixed income and equities into an investment portfolio inside your trust, or those fiduciary roles. They will customize your investment portfolio, catering it to the client or the grantor's needs and wishes with respect to the trust agreement. And just to let you know, we'll both manage qualified and non-qualified accounts. Those are qualified are basically your IRA accounts, and then the non-qualified accounts are your liquid accounts. When you use us, I'm not speaking about anybody else, but specifically TRUSTCO, you will find that monthly statements will be necessary. We'll provide monthly statements for you. We will provide detailed tax statements. David would appreciate that, where the income expenses, the capital gains and losses are clearly mapped out for your accountant. At TRUSTCO, what we do uniquely is to provide a bill paying service. And many of our clients, many clients, when they get very old, perhaps there is issues with seeing statements or holding a pen in your hand, will ask us to help them out. And we will provide the service of paying their bills for them, whether we go to the home and do it or pick them up and bring them back and do those. But we offer that service as administrators of any account, whether that's just an investment account that's with us or an account with inside of a trust. We offer a fee schedule that incorporates both the asset management and the trust services. Now, this is a very big point. So you paying an investment advisor now for investment advice services, and if you have someone managing a trust, you would pay perhaps on a trust schedule. We do both incorporate both the asset management and trust services together under one fee for service. So that's a very unique thing about us. And these are simplified slides and simplified statements, but John and I welcome the opportunity to talk to you in depth, meet with you, the planning stage, right on into an execution stage. So thank you very much again. Lou, I'm going to hand it back to you for allowing us the opportunity to share our services.
All right. Actually, we're going to quickly hand it back to Dave because now we're at tax reporting and accounting.
Okay. All right.
All right,
Dave, you are up.
all right, I'll run through this relatively quickly since I think we're not trying to make anyone professional accountants, but you should have an idea how this works just so you possibly can do your own return, and at least you should know the concept behind it. So again, once you have a trust, it works the same way as an individual that you do now, and that you have income, you have deductions, and you have exemptions. That's generally what you're used to from filing your individual return. One difference here in calculating your income tax is you have the concept of distributions with a trust. So the distributions, when they're paid out, they work similar to a deduction in that the trust itself will get a deduction for the distribution, and the distribution will end up being picked up as income on the beneficiary's return. Items of income, items of deduction are relatively the same from a tax perspective from how you think from an individual perspective. The one difference really is fiduciary fees and administrative fees, which on the individual side have been eliminated with Trump's Tax Act. They were a miscellaneous itemized deduction. Some of those still are that way on the fiduciary side, but the theory with the trust or fiduciary taxation is if you're incurring a cost because it's in a trust setting or a fiduciary setting, you're able to deduct it as a direct deduction against the income. So fiduciary fees, which would be your trustee fees, can be deductible to the trust, although of course they'll be taxable to the trustee. Has the same limitations on taxes. The TCJA limitation of 10 grand, that'll also come into play. Probably less of an impact on the trust side just because you're not dealing with state withholdings, and often your property taxes are not completely inside the trust. And then administrative expenses are deductible. This is a example of a 1041 with the simple trust. You'll see that the non-grantor trust will be some kind of trust name, but it qualifies as simple trust. You check the box, and it's a relatively simple form to complete. That's the top heading form. This is the grantor trust we talked about before we get to the page on the simple trust. This is what the grantor trust would look like. This is the attachment or the letter you would get. You would file, again, the grantor trust return under the ID number of the trust. The beneficiary, or the grantor in this case, would be their social security number. You can see in the upper left-hand side. It lists below, you'll see the interest income reported on Schedule B. That's a summary of all the 1099s for interest. The ordinary dividend income is a summary of all your dividends. And then if the house was in there, you can see the deductions for interest expense and real estate property taxes. They go on Schedule A. This is the summary letter that would then go to the grantor. The grantor would take this information and put it right on their 1040, and their 1040 would ultimately look the same way it looked before you created the grantor trust. There's just a step in between.
So Dave, in a revocable trust, the assets generally stay under the social security number of the grantor when they're serving as trustee. So you don't need any real additional return. All the 1099s come under your own social security number. We do recommend for a grantor trust, although it isn't essential, IRS says so, for Medicaid purposes, if it's a Medicaid asset protection trust, you absolutely want to have a tax identification number. Your 1099s come into tax ID number. You're going to do a 1041 and then just attach that grantor trust letter to your 1040. So everything looks and feels on your 1040 the same as it did before. But as you said, with that one intervening step. And then when you get to complex trust, that's when you really need to consult. And
Right.
That's kind of where we are.
Right, and just real quick on this simple trust on the form, you'll see how it works. You can see the interest income is $750, the dividends is $32,750. You can see the line 10 and line 11 were your taxes and your interest deduction to get to your total deductions. And you can see that the net income is $21,500 of the trust. Normally you'd say, hey, that's the net income I should pay tax on, but you get this concept of the income distribution deduction. And that's because as a simple trust, it's required to pay out all the income to the beneficiary. The beneficiary receives that $21,500. The trust gets a deduction for it and thus pays no trust tax. And if we go to the next slide, you'll see the reporting. This is now the beneficiaries reporting. They get a K1, very similar to the grantor trust attachment we just talked to. But again, this is in a simple trust setting. The beneficiary receives this and they're picking up, you can see that line 2A and 2B, they're picking up $21,500 of dividends to pick up on their return. And it's a result we would want. It's a required result because you're required to distribute the income. But again, the individual rate is probably less than the trust rate. And this is what pushes the income out from the trust to the individual. And this is how it would work in a complex trust setting. If we didn't make that distribution because it was a complex trust, the trust would pay all the tax. But since we did make the distribution, the individual pays the tax. And we highly recommend also on the grantor trust that you get a separate ID number, treat it separately. It is a separate trust, and I think it provides a lot of benefits from an income tax and certainly for what you guys are doing.
Great, I totally agree about the EIN number for the trust. We want to show separation. Again, that's one of the reasons we're not appointing a trustee, the grantor as a trustee and an irrevocable trust. So now what's left? Trust administration at death, okay, and how you should handle that. Again, we're doing a trust to avoid probate, and we only avoid probate in as well as the trust is funded. That means that in a lot of cases with an irrevocable trust, people leave a bank account outside the trust. If you don't put beneficiaries on that bank account, it goes into an estate and you're right back where we didn't want to be. Okay, during COVID, all of these times have been much worse. It's been a year in some places downstate without anything being issued. So probate petition filed, no letters. Okay, at a minimum, an estate needs to be open for 7 months. Normally, it's open for a year. In the best case scenario, a year to 24 months would be more typical. Longest estate that I personally witnessed was 8 years, obviously heavily litigated, but that's one of the issues what we get when we go to probate. Okay, these are issues that can come up in probate, complicated assets. That could be a business, it could be property with several owners, minors, because you can't just hand money to a minor. There needs to be a guardian appointed. That comes with its own issues. You may have an incapacitated distributee or beneficiary. The difference between a distributee and a beneficiary is a distributee is a person who takes, if your will didn't exist, those people have to be put on notice until the will is validated. If they're incapacitated, either because they have special needs, they've been in an accident, or they're just dementia or Alzheimer's has become an issue, it can be a real problem and slow things down. Predeceased beneficiaries can also be very difficult. We have a state where there are 68 potential distributees, so you can understand that might take some time and money to handle. Charities, if you leave a percentage of your estate to a charity, the AG will be involved and make sure that they get what they're supposed to get. That requires an accounting, so that needs to be done carefully. Creditors, and again, if you have disharmony in your family and an estate, it usually is going to come out. And if I'm involved, a lot of times it's devolved into litigation and maybe a will contest. All of those things have one thing in common: they cost money. And there are other things such as court fees. So a probate petition can come with a pretty hefty filing fee, depending on what the assets are. It can be $1,250 or it can be $2,500, and that's just the filing fee. If we're not sure who your heirs are, that's very complicated. We might need to involve a genealogist. Again, it comes with a heavy fee burden. Service of process, bond, if you're out of state or there's potential contest, a bond may be required. Again, you may have to file an accounting. There may be appraisals. All of those things can be avoided, or most of these things can be avoided if we stay out of probate altogether. And how do we do that? Well, you probably figured that out already, but we're in a trust, okay? The assets in a trust go according to what the trust says. There's no probate involved. If you've done this with us, or you've done it with someone who knows what they're doing, if someone is predeceased, there's a successor beneficiary in place, or at a minimum, a savings cost to tell you where you should go. And this is a big one for a lot of people, that financial affairs remain private. Look, if you're not a famous person, maybe someone's not going to go into the court and look and see what your will says, but there may be a real value in not having all of that out there, especially if you need to, if you're not making your child the trustee of their own money, or there's other things going on. The privacy is a portion that is lost if you go to probate. Distributions to beneficiaries outside of probate. So revocable trust, first spouse passes away. Generally speaking, this is all to a survivor. Lou, that may be different in an estate tax scenario.
We create trusts for tax sheltering. They call them credit shelter trusts. And that can be done through a number of different mechanisms. So if the married couple together is maybe over the single exemption limit, you can still arrange the trust so that you maximize both exemptions, which doubles the benefit. And that's all done at the first spouse's death.
Right, so it's critical at that level to pay attention to the planning. We have seen several people not inform their lawyer that the first spouse has died, and you don't want to lose a planning opportunity here if you have. There also, you might have testamentary trust, although generally speaking with a revocable trust, we're trying to avoid that. But in one potential specific Medicaid situation, we do force a testamentary trust because it's automatically exempt. So the devil is in the details here. So when you get to that point on the first death, it's at least worth a call to your lawyer to talk about whether there's anything to do or not. Second spouse's death, generally there's more work to be done. Some clients are leaving it outright. More and more clients, though, have taken us up on our advice to leave it in the beneficiary controlled trust and protect against those creditors and predators that Lou has talked about. It may be a spouse now, it may be a later spouse, or it may be even something so much as innocent as you pass away, your child then passes away. If you left the money outright to them, 9 times out of 10, they're going to leave it to their spouse, and it may be out of the bloodline permanently at that point, rather than to your grandchildren. If you have them, we can control that. So at this point, we need to establish those BCTs, get them their EIN and a certification of trust, and people are on their way. There was a question about whether a beneficiary can be a trustee, and they absolutely can. The area that we want to avoid is in the Medicaid Asset Protection Trust. We don't want the grantor being the trustee. Here's a little chart about BCTs. Again, this could be fully bloodlined, or it can be left to the discretion of the child. Most of our clients are looking to keep the money in the family. And if there's money left in this trust at the time the beneficiary dies, the trust specifies that it goes on to their children. Nothing else needs to be done. It's really provides a lot of peace of mind for our clients of knowing that the money is going to where they would want it to go.
And Aaron, this has been one of the biggest game changers in our practice over the last 12, 13, 14 years since we started really focusing on the planning for the children, the grandchildren. A lot of attorneys used to and still do maybe hedge their bet and say, okay, we're going to leave something to the children at 25, something at 30, something at 35. You stagger distributions. We used to do that ourselves. And then we got the idea through court cases in New York State in particular. And again, this is state specific, but New York courts have upheld the spendthrift nature of these trusts, which is the asset protection piece, even though the child is a trustee of their own trust, even though they are a direct beneficiary of their own trust. If it's structured properly, the child can have full control, full access, and still have it protected for creditor purposes. It also then, Aaron, falls outside of that child's estate for estate tax purposes. So it's fully protected, it's outside the estate tax system, and we can utilize these trusts to grow wealth generation over generation, so it doesn't get lost in a divorce proceeding. You lose 50%, or you go bankrupt, or you get a lawsuit. These assets stay protected in the family. It's what I have in my document for my children, and it's what, once we present the value proposition, it's what most parents do when they're doing their planning, whether it be in a will, but more effectively in a trust.
Absolutely, and they will become even more popular, I think, as the estate tax situation changes, because I think we all believe it's going downward. So there are some tax filings required at death. I believe Dave is going to touch briefly on these and what needs to be done.
Of course, there's more paperwork to do. So when you have a passing of someone, there's the final 1040, which may or may not need to be filed. There's no requirement that you file a final 1040 if it's not required based on income level. So if someone were to pass January 12th, there may not be a filing requirement if there's no income in that 12-day period. But you need to look at that, and either the trustee may have to file it or the executor has to file the 1040. You have the estate 1041. So if there happens to be any assets that fall under the estate, not under the trust, outside of either trust or direct contractually between the beneficiary, and there's an actual estate filing, there's a 1041 with that as well. There's also the trust 1041, which if you had more than one trust, you'll have a few trust 1041 filings. Again, it's a separate entity, so it needs to file tax returns as long as it meets the income requirements until the trust is terminated. And then you have the actual estate tax return, which is the tax based on the value of the assets that the decedent happens to pass with. So again, if we've got an $11.7 million estate or a $5 million estate, let's say there may be no estate tax due and no estate tax filing requirement, but to actually claim the portability, which is where the spouse, the husband and wife, the husband passes, for the spouse to double the exemption that you get on the federal side, you do need to file a timely estate tax return. So we often file them, probably not as neat as they would be if they were a taxable estate, but we certainly file them with all the disclosures and the assets on there to make sure we're allowed to get portability in case, first of all, they could be over the combined threshold, but you never know what's going to happen in the future of your life. So you've got some kind of sizable estate, you should claim portability. One aspect on the timing issue is just on the trust and the estate, more the 1041 for the trust of the estate. There will be fees you incur. There'll be some, obviously some professional fees, maybe some other expenses related to just getting the assets of the estate or the trust administered. If those expenses are incurred during the same year that the trust is actually earning the income, then you can offset the two. And if they are in excess of what the income to the trust is, there are benefits on the individual beneficiary side that net loss, so to speak, or those excess expenses can be pushed out to the beneficiaries, but it needs to happen in the year that you're finalizing the trust or the estate. So there is some planning around that you should talk to your accountant with as well when you're doing those final returns.
And Dave, the trusts are not always treated the same as individual returns. For example, the extension on individual personal returns is different this year.
Yeah, the trust due date is different than it's a month sooner than the individual due. Well, this year, because we have another COVID year where they extended the due date of the individuals, but not the due date of the trusts. So hopefully, if you didn't file those, you're a little late on that at this point. But yeah, they file separately, and the estate can be a fiscal year. It doesn't have to be a calendar year, whereas most trusts are required to be a calendar year.
Great, thank you. Sometimes a trust can require an accounting, or a beneficiary would like an accounting. A beneficiary can get an accounting or a trust will. For any period of time that trustee was acting, this becomes one of those things where sometimes it's a good thing to file an annual accounting, depending on the type of trust. If it's generally speaking, we can waive this, but if there are going to be issues and you're the trustee of a trust, not the grantor, let's say, but of an irrevocable trust or a trust for someone else, you're going to want to make sure that you're keeping good records and maybe filing an annual accounting to put those questions to bed, or if not, filing accounting every few years, because these devolve into litigation a lot, and it's then incumbent on the trustee to show what they've actually used the money for, and they've used it for proper purposes. So this is very fertile litigation area and something to be very careful of if you're a trustee. Lou, I'll leave this one to you.
So when a lot of our clients say, okay, I'm going to create this plan, we're going to do our funding, we're going to get all the assets in the trust, but we talked about Medicaid law changes, tax law changes, people have changes in circumstances, people pass, people are born. How do you keep up with this? How do you make sure your plan stays current? We developed a number of years ago, going on 20 years, believe it or not, a system. We call it the Lifetime Maintenance System, and we call it Professional Advocates Lifetime Maintenance System because it has a nice acronym, PALMS. And I will confess to you that I am right now in Marco Island, Florida, and I'm looking out at a palm tree. But I'm here, and I'm here partly on vacation, but yesterday I had 2 PALMS meetings with our clients who have moved to Naples, Florida. So we retain them as clients. I met with them both down here. We went through a report that tracks each of their assets. We look at asset values. We update it on an annual basis. We talk about prospective changes in the law and changes that have already occurred. And then we make recommendations to adjust and modify the plan. And yesterday, one plan is going to stay intact, but the other plan, because of all of the tax law changes, is going to get an update based upon this annual meeting. In your materials, Form 12 lays out the agreement for this annual meeting. We give you an annual consultation. We give you an update, and we provide a report that it's online technology, secure website that has all of your information, data, and documents stored there. You can access it. We can access it. We update it on an annual basis. And we also give you some telephone time during the course of the year. All that's laid out in the agreement that's in Form 12. I'll share with you the total cost, which is $850 a year. That includes 2 hours of attorney time on the phone, your annual PALMS meeting, and the update of your PALMS report. So Aaron, this has been a valuable tool for many of our clients.
Absolutely.
And it's really kept them current, and they go to bed each night knowing that they're doing everything that they can possibly do to make it better for themselves and for their kids and grandkids.
Right. It's great to get out and plan, and we're big proponents of that, but you need to pay attention to make sure that the plan stays up to date. If you have changes in your family, changes in the law, you want to make sure that you're updating at all times. So PALMS is a great mechanism for